Welcome to the deep dive.
Glad to be here.
Today we're digging into some big moments in the Indian stock market.
Yep, the nifty crashes, specifically the ones over 20%.
Right, those significant drops. And we're looking at how the monthly relative strength index, the RSI, behaved around those times.
Exactly. The question really is, can this RSI thing give you, the listener, any reliable clues about market crashes? Does it show consistent patterns?
Okay, so maybe first, just a quick refresher on RSI.
Sure. So RSI is a momentum indicator. We're looking at the 14-month version here. It runs from 0 to 100. And, the basic idea is anything over 70 often points to potentially overbought conditions. Maybe too much buying, too fast.
And below 30.
Below 30 can suggest the opposite, oversold. Maybe the selling's been overdone, hinting at a possible recovery.
Got it. And our definition of a crash today is that nifty drop of over 20%, basically a bear market signal.
That's the one. So shall we jump into the history?
Let's do it. First up, the big one. 2008, the global financial crisis. Nifty fell. What was it, about 65%?
Yeah, roughly 65% between January and the low in October 2008. A massive, massive fall.
And the RSI, what was it doing before that?
Well, this is fascinating. In October 2007, so a few months before the peak, the monthly RSI actually hit its highest recorded value near 86.
86? Wow. That's extremely high.
It screamed overbought, just showed huge buying momentum leading right up to the edge.
So then the crash happens.
And as the Nifty tanks, the RSI plummets too. I mean, it likely fell hard through mid-2008, probably into the 40s or even lower.
And at the bottom in October '08.
By the absolute bottom, yeah, it was almost certainly well below 30, deep into that oversold territory.
So the pattern there, extreme RSI high, then a crash, and the RSI follows it all the way down to oversold.
Pretty much sums up 2008. Extreme reading, then the fall.
Okay, let's move forward. What about the 2015-2016 correction? That was around a 25% drop.
Right, April 2015 to February 2016. And yes, we saw a somewhat similar RSI picture, though maybe not quite as extreme as '08.
How so?
Well, the RSI peaked beforehand, around 81 in November 2014. Still very much overdot, above 70.
Okay, so another high reading preceding the drop.
Exactly. And as the Nifty corrected over those months, shedding that 25%, the RSI also fell quite a bit. By early 2016, it was probably down in the 30s or low 40s.
Approaching oversold, but maybe not quite plunging below 30 like in '08.
Possibly.
Yeah.
It definitely reflecting the significant cooling off after that peak.
Interesting. Now 2020, the COVID crash. That was incredibly fast, wasn't it? Almost 40% down in like 2 months.
Yeah, February to March 2020. Brutally quick. And here's where the RSI story gets a bit different in the lead up.
Oh, how? No high reading.
Well, not extreme. In late 2019, the monthly RSI was likely in the 60s. Healthy, bullish, but not up in that 70-plus warning zone we saw before '08 or '15.
So the RSI didn't really predict that crash in the same way?
It seems not. This crash was driven by a sudden external shock to the pandemic. But once the market did plunge in March 2020,
The RSI reacted.
oh, absolutely, it dropped like a stone. Yeah. Very quickly fell right into oversold territory, likely into the 20s or low 30s.
So even without the prior high reading, it still reflected the severity and speed of the crash itself.
Exactly. It shows you that these indicators react strongly during the event, even if the preconditions are different, especially with these black swan type events.
Right. Okay, one more period, the recent 2024-2025 decline, nifty high in September 24, then a fall into early 25. The numbers showed maybe a 16% drop for Nifty itself, but broader markets fell more.
That's the picture, yeah. Mid-caps definitely took a harder hit, over 20%. And some suggest Nifty maybe flirted with 20% down intraday or on slightly different time frames. It was a significant pullback.
And the RSI leading into that, September 2024.
It was high again, around 83, clearly overbought.
So back to the pattern of high RSI preceding weakness.
Seems so. And as the market pulled back through February 2025, the RSI definitely would have dropped significantly from that 83 level, probably into the 40s or maybe even the 30s.
Reflecting that market stress, even if the headline Nifty index didn't breach the 20% mark uniformly.
Precisely. It showed a major cooling off from very hot conditions.
Okay, so pulling all this together, looking across these different crashes, what are the sort of main patterns or takeaways for you, the listener?
Well, I think a key thing is that often before these major Nifty crashes or corrections, especially the ones that unfold over months, you tend to see the monthly RSI up in that overbought zone, above 70 or even 80.
Like 2008, 2015, and the lead up to the 2024 pullback.
Exactly. But 2020 is the important exception, right? A sudden shock can trigger a crash without that extreme prior reading.
But in all cases, during the crash, the RSI falls sharply.
Yes, definitely. As the market drops over 20%, that monthly RSI usually tumbles, often into the 40s or 30s initially.
And sometimes lower.
In the really deep or prolonged crashes like 2008, or the very sharp one like 2020, it did hit those classic oversold levels below 30,
Yeah.
often near the market bottom.
Interesting. So it acts as both a potential warning sign beforehand in some cases and a reflection of the severity during and after.
That seems to be a reasonable takeaway, yeah. It tracks the momentum shift.
So for you listening, the final thought is this. Knowing these historical tendencies, the high RSI often preceding trouble, the sharp drop during the fall, the potential for oversold readings near bottoms, how might you weave this into your own market analysis?
Right. It's never just one indicator, of course. But how could understanding these RSI patterns, alongside everything else you look at, help you think about market risk? Or maybe even potential turning points?
What further questions does this raise for you about market psychology and technical signals? Something to ponder.
Definitely.
That's our deep dive for today. Thanks for joining us.